Welcome, everyone, to the Directed IRA podcast with Mark Kohler and Matt Sorensen. Delighted to be with you today. Hoping you're having a merry, happy holidays.
Yeah, yep. And we are in holiday spirit. For those that are watching on YouTube, I've got a little fireplace behind me. I was going to wear a smoking jacket, but I thought, no. Rose Bowl attire.
Oh, I like that. The Utah Polo Pac-12 champs, baby.
Yes. Woo. First ever. So excited. So I know some of you East Coast people didn't realize football existed, west of the Mississippi, but it does. It's called the Pac-12, and Utah won this year. So we're going to the Rose Bowl, baby.
Yeah.
Woo.
Well, some big news there.
Yeah.
Well, if you saw the topic today, there might be some quandary about this, but what we really want to focus on is getting the money in and out of your account properly. Everyone wants to talk about building your retirement account. We're always talking about what do you want to invest into, but there's some kind of these nuts and bolts stuff that you got to nail and get right so you don't screw it up. And that's what we're going to hit today.
Yeah, I know. And it doesn't sound really exciting or sexy, but this is kind of like eating your broccoli. You got to do it. And you're going to feel better when it's done. You're doing the right thing.
Yeah.
Your cholesterol will go down. Your stress.
Broccoli gives some people gas. So I don't know. You feel better when you do it. You're like,
I didn't know that.
Podcasts on IRA contributions and distributions make my stomach sick too.
Okay. Eating your vegetables. All right. So here's the official title, everybody. Getting money in and out of my IRA without screwing it up. Now, when we say IRA, of course, you regular listeners know that could be 401k, that could be HSA, that could be all these different pieces. But It can be overwhelming. You go to the website, and Matt and I try to be consumers of our own. What do you say? We drink our own Kool-Aid. So I go to the website sometimes, and I'm like, okay, what do I click on? Because I'm trying to do this, a backdoor what? And it's easy to screw up.
Yeah. But you're captaining your own ship. You got to do it right. No one's holding your hand there. You got professionals and people you can rely on. But frankly, if you're calling your accountant or your attorney with some of these questions, it's like, you kind of need to know this stuff. I'm just going to be like, you have this account. It's like, you're a gun owner, or you have a driver's license, like you have a car, like you want to really learn this stuff. You don't need to be an expert, but just learn the stuff that you got and how the rules work. That's the best way to make sure it's getting done right. Because, I was figuring this stuff out using before Directed IRA other places, and it was a nightmare. And we tried to simplify things like the Backdoor Roth IRA in some specific packages. But so some of the stuff's technical. I'm sorry. That's just write your congressman. What can we say? We're going to try and break it down, though. That's what we want to do today.
We're going to make it simple.
Common mistakes, make sure you can avoid them.
Yep. I love it. And we'll keep it simple and move quick here. And maybe it's a full podcast length. Maybe it's not. I just took my glasses off because I realized I was taking my nerddom to a new level. Did you see my glass? For those on YouTube, my glasses broke and I'm literally holding them together with a paper clip. And I was just wearing them. And I'm like, maybe I should explain why I have a paper clip in my glasses, but I'm going to the optometrist this afternoon to get another pair of glasses or fix. But I was going to garner a pocket protector, and
wow,
maybe I shouldn't do the white tape. I thought a paper clip.
Yeah, that's kind of like Revenge of the Nerds type style right there.
I could have.
Yeah.
Okay. Well, let's talk about getting money in first. So, and maybe we should talk about, I think 401ks are a different animal. So
I got 4 categories on getting money in. I want to hit 4.
Okay. Oh, you're all organized.
Money in. Maybe I made notes for today.
Oh, holy crap. All right. Well, my captain, let me stand at the desk here and I'll just listen.
If you made some notes, that's,
you trump them. You take control of the meeting if you show up with notes.
Yeah. Okay. All right. Let's talk about the Roth IRA. I want to talk about the most common screw up we see in Roth IRA contributions. There's 2 of them.
Okay.
The first is screwing up the backdoor Roth IRA. Mm-hmm. The backdoor Roth IRA requires a traditional IRA and a Roth IRA. You put the money in your traditional IRA and you convert it to Roth.
You can't fast track it.
You can't just go into a Roth IRA and just set up a Roth IRA at Directed or TD Ameritrade or whatever type of place you're at and just be like, but I'm doing backdoor. No, you went in the front door. You already were told
Get
you
out.
can't go in.
Get out.
Yeah, the IRS like, get the heck out of here. You were not authorized. All right.
Yeah.
The back door is the way you got to get in, which requires the traditional, which you contribute to, and then you convert, and that's the back door into the Roth.
Okay. Can I add something? One other precursor to this is a lot of people, even before they get to this level step, you have to convert your old traditional money. And so if you go, oh, I want to do a backdoor Roth, you might already be primed and ready to do a backdoor Roth because you already have traditional money sitting around.
Yeah.
Now, unless you can roll it into a 401k, which is your secret way out of that. But if you have a traditional IRA, convert that first before you play with this backdoor.
Yeah. And some clients like, but I've got 500 grand in a traditional IRA. I don't want to convert it. Sorry. That's the IRS makes you convert that pile first before you start doing backdoor. So, okay. So that was
card, and your get out of jail free card is if you do have a $500,000 traditional and you don't want to convert that to Roth, set up a solo 401k under your side hustle, move it, done.
Yep. Because traditional 401k dollars are not go into effect with that. You can leave traditional 401k dollars and don't have to convert. It's just your traditional IRAs. You have to convert to do the backdoor Roth properly.
Now Merrill Lynch makes this two-step process of the backdoor a pain in the butt. But Matt Sorensen, please tell us how you single-handedly solve this problem.
Well, we got some team members here that helped out with that, but I'll come accept the trophy, I suppose. So we have an all-inclusive backdoor Roth app. It does three things, because this is what I was doing. I was doing the backdoor Roth IRA before you had directed IRA, and I had to do all these three things separate. It sets up a traditional IRA. You contribute to the traditional. It sets up a Roth IRA. And it does the conversion all in one document package. Okay. So in one doc set, I can set all that up and authorize all those things. Boom.
And you only pay one, or is it 1.5 account setup?
Yeah. You get a discount on the traditional because it's kind of a dummy account that you're using to, make the contribution and convert. So it's a cheaper fee.
Now, I want
account package.
I wanted to ask this for me personally, because I did this year too. Is my dummy account still set up? So if I'm ready to do it.
So when you do the application, there's a box to check, close my traditional, I'm only doing this once, or leave it open, I want it for next year. If you check, leave it open, I want it for next year too, then it's $100 a year to have that dummy account. And it stays open because we do have to report to the IRS on that account, even though it's at zero and you convert out of it. But most people are doing the backdoor want to keep that dummy traditional account open. It doesn't have anything in it, because you've moved it all to the Roth, you've converted.
Now, if you're going to do this conversion, you got to do it before is that number 2 mistake, is you don't do it before you're in?
No, but that's a great one. I think you could add. This is a great
one. Another screw up is, see, a lot of people think, well, I can contribute to my IRA before March 15th or April 15th. I got but with the conversion and the back door, if it's for this year, you really have to do it before December 31st.
Yeah. And if the tax bill passes, that's right now in the Senate, that's going to close out the backdoor Roth. If it passes, that's going to close it out from converting in 2022, non-deductible dollars. So you want to do it now.
No,
so if you're like, wait, I know I contribute, because here's what you could do before, and you could still do right now, unless this bill passes. You could do your 2021 contribution on April 15th. And you could convert on April 15th. That's literally the deadline. Please don't do that. But any IRA provider will hate you. That's not a great day to do that. But you know what I mean? Yeah. You got up until the deadline. It's because that's still a 2021 contribution. And the conversion is just going to go on the books in your 2021 tax return, but it's not taxable because it's this backdoor. So who cares? But this year being the caveat that the current pending bill is going to close out the ability to convert these non-deductible dollars. So if you make non-deductible contributions, those are going to stay non-deductible forever, which is not great because you have to track the income separate that's taxable, and it's kind of a mess. So if you're thinking, I want to do a backdoor Roth for 2021, do it now.
Okay, now hold it. Now, you just told me yesterday there's a phase in. Is the phase in on
Roth conversions, for Roth conversions, but not for backdoor Roth? Like a regular Roth conversion. Let's say you got traditional dollars and you want to convert to Roth in your IRA or 401k, just regular, traditional, deductible, typical what people have. Cool. You can convert to that until like 2032. Even if the bill passes, that's that.
The old money, the old traditional money you have.
Right. But if
But
you're doing non-deductible, which is what the backdoor Roth is, what the mega backdoor for Roth 401k is, that's getting closed out immediately.
Okay.
2021 will be the last year you can do it. And literally, it's not April 15th for, it's by December 31st. You better do it.
Gosh, I love your body, Larry.
Chuck and Larry.
Now, for some of you that are like, see, that quote is a very important quote. I love your body, Larry, because there's this great feeling. It's from Fletch, and Chevy Chase is on the phone with Gina Davis.
Oh, that's what it's from.
And you didn't know?
I didn't know it was from.
How many times have I told you to watch Fletch? I hadn't believed
I've watched it. And I did like it. I was just, I turn on a movie and I end up like doing 20 emails too. So I miss these critical lines.
Yeah. So he calls Gina Davis Larry, and he's on the phone in the hotel in Utah, mind you.
Yes.
In Jim Swarthow's place, working on, see, I know that this is a part of me.
Yeah.
So, okay. So you got to do your conversion before year end. If you're doing the backdoor, you want to make sure you do the following steps. Now, if you go to the Merrill Lynch's of the world, you're going to have to follow this very closely, because you have to open the traditional, make sure they know it's a traditional, then do the conversion paperwork, and it's not uncommon that they screw it up because they think you wanted a Roth from the beginning. And so they just arbitrarily change your account and screw it up. So be careful if you're going to use your regular financial advisor. Make sure they know you're doing a backdoor so that they don't jack it up.
Yeah.
Okay. What was your second category on Roths?
A second category on Roth was you end up making too much money. And sometimes this is, this is a great problem to have, right? You just did a regular Roth contribution earlier in the year. Let's say you did it in March and now it's like December and you're like, whoa, I'm over the income limits on Roth. I'm making a couple $100,000 this year. I didn't qualify to do a regular Roth. So I got to fix it. That's cool. We did a whole podcast on this maybe a month or so ago, five podcasts ago, perhaps. You can fix that. And basically you're just going to do a backdoor. You're going to recharacterize it to traditional and then convert to Roth and say there's a way to fix that.
Yeah. But everybody, there are deadlines.
Exactly.
And and I've got a client that made a contribution to a Roth, and months later they realized, oh my gosh, I made too much money. Well, their tax return had already been filed. The recharacterization period from an easy fix was over. And so there's additional steps they had to take. I've been working on an article for this forever. It's on my desktop. But the podcast is really helpful. Go back to the podcast, folks, and that'll help guide you. And then I hope to have an article on this out soon.
Okay. So that's common issues on Roth IRAs getting in.
That's it? I got more.
Okay, go ahead.
Okay. Here's the other problem. Some of you on a Roth contribution are trying to contribute to your kids' Roth. Ooh. Not Kid Rock. I love Kid Rock. This is your kids' Roth.
No contributions to Kid Rock here. We do love him, but the guy doesn't need any contributions.
Yeah, he's a really good guy. He does a lot of charity work. I'm just a little shout out to Kid Rock. Okay. Now, if any of you are thinking, okay, I want to contribute to my kids' Roth IRA, well, the backdoor is totally unnecessary. They're going to be fine income-wise. And it's not that they made too much income, is can they show any income at all? See, people can have a Roth, you got to show earned income. Now, you have until April 15th again, but before December 31st, you've got to pay them out of your side hustle a dollar amount that they will could claim on a tax return. Maybe they do a return, maybe they don't, but they've got to have earned income in their bank account. You just can't say I paid them. You can't say, oh, it was allowance or some bill crap. They have to have their own bank account. You have to transfer the money from your business to them and document it. Now, I'm not saying W-2 or 1099. Go listen to our podcast at Mainstream Business on that. But you've got to make sure they have earned income. Or it's going to fail.
Absolutely. Yep. Before December 31st. This is a good time. Paying your kids. This is when I'm always doing it at the end of the year. I'm always like, okay, I got to make sure I'm tracking that, paying the kids. That'll let you get the Roth IRA contributions in, which again, you'll have until April 15th the kids ones. And by the way, at Directed Ira, we do have a kids Roth specific application, because there's some quirks on that too, about the parent having oversight on the account for the kid and all that. So we got you.
And I think it's important to point out the grandkids. I'm going to actually be a grandparent next year. Boy, does time fly.
Wow.
I know. And you're just a snowstorm and
Grandpa Mark.
So, yeah. I mean, if you didn't hear that, everybody,
like Papa Smurf now. Yeah. Whoa, you're like old.
Matt, I mean, since his kids are not living in a cold climate, I won't say they're snowstorm and 9 months away. They're Matt's just a rave party and 9 months away.
Don't say
that's terrible to say. Okay, now if you're paying the grandkids, again, you have to show the grandchild with earned income, and the best way to do that is through your kids, their Schedule C.
Yeah,
we've got, again, podcasts on that over at our sister podcast, Main Street Business. Get over there, and we talk about paying grandkids. But again, that's a screw up one, because grandparents are like, well, I'm going to put money in my kids' Roth, my grandchild's Roth IRA. Well, that sounds great, but there's a procedure. You don't want to screw it up. So earned income is the trick there. Okay,
all right,
your next category.
Okay, let's go to traditional IRA contributions. Okay, here's a common mistake on traditional IRA contributions is I have a 401k at my day job, or my spouse does, and I can't contribute to a traditional IRA because we're over income limits. So if you don't have a 401k at your day job, or your spouse, or any job, or your spouse doesn't, there's no income restriction on traditional IRA contributions. Knock yourself out. You make $1 million a year, you can throw $6,000 in your traditional IRA. But if you have a 401k at your job, or your spouse does, and you make over a certain income limit, it's in like the mid 100,000s. It's a little more if you're married versus single. You cannot contribute to a 401k.
IRA.
Sorry, traditional IRA.
Yeah.
Now you can do backdoor,
which is better anyway.
Backdoor Roth.
Yeah.
If you're higher income, it's better anyways.
Let me say this another way too, if some of you got a little confused. You can have a 401k and do a backdoor Roth all day long. Your spouse can have a 401k, and you're like, well, my spouse does, but I don't. Wait, your spouse has one. You're kind of dragged into this rule. So if your spouse has a 401k, both of you can have a backdoor Roth. But if either one of you have a 401k at work, whether you contributed or not, doesn't matter. If you're eligible at a 401k at a day job, you or your spouse, then you've got to go to the second tier of analysis and say, what's my income? And can we do a traditional? Did we make too much money? But I'll tell you, the best bet, just go freaking backdoor Roth, or Roth period. I don't know. I'm just a huge Roth fan. So
of course, yeah. I mean, tax-free on the way out, baby. Okay, so that's a common one, the traditional side. I want to jump over to HSAs though.
Okay, well, can I bring up a topic too that I think comes up with a lot of our crypto clients? Maybe this is a nice little intermission in your list. I get the call constantly, Mark, I've got a 500 grand in my crypto account, my wallet, or I've got a piece of real estate worth 500 grand. I want to put that in my IRA, or I want to put that in my Roth. Regrettably, you can't take an asset and contribute it to an IRA. A mistake that people think is that they can do that. It has to be converted to dollars first. And that means you're going to recognize a sale, a gain. And so many of these crypto clients are so frustrated because they're like, hey, I heard I can have crypto in my Roth. Yeah, you can buy crypto in your Roth, but you can't take the crypto you already own at that basis and push it into your Roth. You got to sell it, take the hit, contribute to your Roth, and start fresh. So I think that's a mistake. We would stop you from doing that. We wouldn't let you do that. But some clients call up and have dreams of grandeur, and we have to squish them. And it's not a fun thing. It's very sad.
Yes.
So we have two buttons in our office. If someone has to get bad news, it's called bad cop, beep, Matt Sorensen. If it's good news, they go good cop, beep, Mark Kohler, and then I get the call. So it's something I implemented early on in our phone system.
You're so smart.
Okay,
So
HSAs.
strategic. Okay, HSAs, baby. Let's talk about those. They're kind of nice in an HSA. There's some nice points here. You don't need earned income. There's no income phase out if you got a lot of earned income, or income in general. But you do need a high deductible health plan that is also HSA qualifying. I've seen a couple people make the mistake of like, oh, I have a high deductible plan. Yeah, but is it HSA qualifying? There's a couple other little nuances on those plans where they have to have certain benefits available to make it qualifying. Yeah. The other one I get that messes up on the high deductible plan is they say, oh, I got a cost sharing ministry. That's high deductible because I don't reimburse me until I like have 5,000 in medical. My cost sharing ministries don't qualify as a high deductible qualifying HSA plan. So just be careful on that one. Make sure the HSA, the health insurance plan you have, works for an HSA.
And we're going to be talking about getting money out here in a minute, people, because getting money out of your HSA is probably one of the trickier ones, which we'll bring up. Okay. But here's another mistake or something about the HSAs I want to bring up is you have people go, well, can't I move money from my IRA to my HSA? And that happens. People go, I have a medical bill, but I don't have any money in my HSA, but I have money in my IRA. So, but the mistake people make is they think they can do this every year, and it's a one-time opportunity. So if you want to put your $7,200, if you're married, head of household, or single, $3,600 this year in an HSA, but you're like, I don't have enough money, but I got money sitting over here in my IRA. You can do a one-time rollover, for lack of a better word, maybe contribution from my IRA to my HSA. And there's a form for that, a directed IRA. Or do we
no, because it doesn't happen often, Rich. We make a specialty general authorization form for that. So we can do it if you need to.
The other thing about HSAs is a lot of times people, and I think this relates to the IRA issue of putting money in your IRA or putting money in your Roth. A lot of our clients, you wouldn't be listening if you weren't self-directing. You might have a Roth with an LLC. You might have an IRA with an LLC. You might have an HSA with an LLC. But you can't make the contributions to your account every year to the LLC. You have to go in through the account, and then the account may be able to put more money in your LLC.
Ooh, that's a good one.
Did I impress you with that one?
Yeah. Retirement account contributions go to the retirement account, not to the LLC. IRA, put it in the retirement account first.
Yeah. And you would think, well, it's just going to end up in my LLC anyway. And I agree with you. But if you're going to launder money, you have to launder it through the right path. Watch Ozark.
It's true. It's got to go to the washing machine, then to the dryer, then it's clean.
Boom.
Able to go out into general circulation.
And spoiler alert, if you want to pay for a medical expense, it can't go from the HSA LLC. It's got to go LLC back to the HSA, and then you call your HSA provider and go, can you send me the reimbursement? Or if you move it to another HSA where you have a Visa card or something like that. But just remember, folks, you can't do these in and outs at the LLC level. You're going to do it at account level.
Yeah, great point. Okay, last on the category on the getting money in is the solo case.
Oh.
Okay, there's some.
This is good. I got a fifth category. I'm excited.
Okay.
So all right. Solo 401ks.
Okay, solo 401ks. Some people set up a solo K in like their sole proprietorship or maybe family management company. They're trying to establish that. And then they want to contribute, but they have no net self-employment income. They have some income, but they expense everything. Well, you can't make new contributions in a sole proprietorship unless you have net self-employment income. Okay, so that's one area. You can roll over other contributions or old employer 401k to it, but new contributions, if you're the sole prop, it's your management company, whatever you're using, those might be tough unless you actually have net self-employment income at the end of the day.
Yeah, I love it. Let me say it another way. Sometimes most people like the way I say it, but sometimes they get it when Matt says it. So let me say it another way.
Every once in a while.
Every once in a while. Okay, let me say it another way. If some of you are running a single member LLC or a sole prop, the same thing, everybody. Remember that. If you have a single member LLC, in a sense, that's a sole proprietorship. And if you're doing a Schedule C as in Charlie, you'll say, well, I set up a 401k to roll over my old IRA money or my old 401k. That's great. You can do that. But if you don't have profit, you can only contribute profit to a 401k. You can't just make it an expense line and run your Schedule C into a loss, which would be kick ass. I would love that. You can't do that. You can only take profit to go to the 401k.
In a sole proprietorship.
In a sole proprietorship.
In a S Corp, what I'm going to talk about second, I'm going to say that's the mistake is profit doesn't matter.
So I guess I was the bad cop there. So go ahead and be the good cop. Damn it.
Okay. Well, what am I going to be good cop on? Oh, the S Corp. Okay. All right.
So the S Corp's the way out.
Yeah. So the S corporation, which is what many of you small business owners have, if you're making 40, 50,000 net more a year, you need to have that for tax purposes anyways. But in an S Corp, you contribute based off the W-2 you're taking. A lot of people think, oh, but man, I took a $50,000 W-2 and I had about 100,000 of profit. So I made about 150 grand from my S Corp. Yeah, you did. How do I run my calculations on what I made? Only your W-2. But that sucks. I want to get more in. And how come I can't use that other money? That's the equation. That's the tax law. So write your congressman if you don't like it.
But it's okay because you pay more FICA if you do.
You got tax savings on this little.
There's a sweet spot, people.
Yes, that's what she said. So
Matt Sorensen, I'm impressed. Coming through today.
Yeah. So remember, in an S Corp, you're calculating your contributions as an employee and the employer match off the W-2. So if your W-2 is 50 grand, you can throw in 19.5 off the, you've made 50 grand and the company can match 25% of the W-2, which is 50 grand, which in this case would be 12,500. So now where do those two numbers get marked? Your W-2 is going to have your 19.5 on it. Okay. Even if it's Roth and you're like, but man, I don't take a deduction on it. Do I even put that on my, yes, it still goes on there. So you need to be coordinating with your payroll company or accountant when you are throwing employee contributions in. The company match is going to go on the company return. Again, this is the S Corps. So this is on your 1120S on the company return. There's I forget the line, but there's a line on there for retirement contributions of the company funds. So now on the sole proprietorship, it's actually going, it's not on Schedule C. I think it's on a Schedule A. It's kind of in an odd spot when you're doing the sole proprietor contributions.
Well, I say Schedule C is where you determine your profit.
Your net income, but then
your net income.
When you expense the deduction, essentially, because you're going to take a deduction for this, I think it's actually on Schedule A.
Well, we have these new Schedule 1, Schedule 2.
Yes, yeah.
And so your accountant will put them on the right line. But for many of you, here's a kind of a unique strategy Matt and I haven't talked about before. See, we tell people if you make 40 grand or more in a Schedule C, you got to be an S Corp. It's just a no-brainer. And so many accountants across the country have really appreciated our perspective on that and our matrix. And we really try to emphasize that. But let's say you're not making 40 grand. Let's say you have a bunch of cash flow from rental property, maybe some money from crypto sales, or your grandma left you an inheritance and you want to put some money in a 401k, but your Schedule C only has, maybe your little side hustle only has 5 grand of profit. Make an S election and you can contribute to the, make the S election. And then you could kick out a W-2 and a 401k contribution and drive yourself into a loss. The loss is then deductible against your crypto gains or your rental property gains or sales by taking that Schedule C and legitimately driving into a massive loss. But it's a good loss. See, we don't want to throw good money at a stupid loss. This loss is all going into your 401k. Ooh, that was sexy. Man, I've got the backdoor Roth, the side door Roth. The backdoor 401k, the side door 401k. What would we call that? I don't know. I got to come up with a name.
That's like the negative edge. It's like the negative edge backdoor.
Negative edge. I'm going to go with that. Negative edge 401k. Ooh.
There you go.
Okay.
All right.
You know what?
That was it on getting in. I got some thoughts on getting money out.
Okay. Well, I got a getting in one too, but crypto. And if you even say the word "that's what she says" one more time in this whole in and out conversation, I'm going to lose. Okay, I'm just trying to hold it together here. You know, this is really not fair that you wanted to hold this. Okay, all right. Now, I'm sorry, ladies, you're probably disgusted with this, but we're keeping it light.
I know it's going to be hard. I don't know how long you can go.
Okay, I was actually going to say something very intelligent here. Okay, so the crypto crowd, they've got all these gains this year. A lot of crypto clients are saying, I've got gains, but just think if you were doing a side hustle driving Uber. See, that Uber creates a Schedule C, and you would never make an S election on a little Uber side business. But if we did make an S election, you could take some of your crypto gains, contribute them to your side hustle Uber business, create a W-2 and a huge 401k. Dude, we could create a pretty massive deduction.
Yeah,
that'd be cool. I was thinking of calling it the crypto 401k. Oh, that would get some hits.
Yeah,
that could be sweet. The crypto.
Well, we do have a crypto 401k where you can have a solo K and then a crypto trading account.
That's what yeah, that too. I mean,
yeah, that's like, what can you buy with your 401k? Here's one other thing that's important. Actually, now that we're hitting crypto, is you cannot contribute crypto to your retirement account. We probably get that once a week. Someone trying to contribute crypto and sending crypto to their Gemini trading account is a contribution.
It's got to be.
You have to contribute dollars.
Yeah,
unfortunately,
as the crypto crowd would call it, USD.
Yeah.
Sorry, man. You got to be in the know. You got to be in the know. Okay.
Yeah.
Okay. Now I have one more category of getting money in, and that is for a Coverdale.
Okay.
Now a Coverdale, everybody. In fact, I'm going to go to my handy dandy Mark J. Kohler calendar, which is already pre-sales are off the chart already. If you want to go over to markjkohler.com, I'm trying to get this out by the end of the month or mid-January. We're waiting for some IRS numbers, but I have all these tables. I've got all the calendars of mine and Matt's events for the year coming up and deadlines. You're going to love it. But in the Coverdale arena, now everybody, let's back up. What a Coverdale is like an educational IRA, which is really cool. You can put money in, it grows tax-free, and it comes out tax-free for the beneficiary's educational expenses up to age 30. So this could be for a kid or a grandchild. And if they don't use it, you can bump the beneficiary to the next generation, or some other kid that got out of rehab. You're like, hey, this kid's ready to go to school. Let's hook them up.
Yeah.
Yeah. Common problem. Okay. Now, but the rule is, and I'm looking at my handy dandy calendar here. If you're single and you make more than 110 grand, you can't put money in a Coverdale for a beneficiary. Anybody. Yeah. You can't do it for your own kid. You can't do it. See, they look at the dollar amount of the contributor, not the parent.
Yeah.
So if you're a grandparent, you want to put money in a Coverdale for your grandchild and you make too much money. And if you're married, filing joint, that's it phases out at 220,000.
Yeah.
So grandparents making more than 220, you can't do a Coverdale for your grandkids. So that's the mistake. People open them up, find out they made too much, got to unwind it. So the trick is find the family member in your equation that makes that low amount. And then you gift them the money to set up the Coverdale on behalf of the beneficiary. And Matt and I came up with the idea and Matt implemented it. We're a great team, Wonder Twin Powers activate. But Matt said, we need on the form for the Coverdale to have a separate section for the contributor and a separate section for the beneficiary and a separate section for the account.
Yeah, responsible individual or
responsible. There you go. So the grandparent can trade the account and the grandkid gets the money, but the actual contributor might be Aunt Jenny that's on Social Security. So you give the money to Aunt Jenny to open up the account. Boom.
Yeah.
So that's the Coverdale trick. And it's very powerful. You have until April 15th on the Coverdale contribution as well. I'm going to confirm that. Okay. Now get money out. What do you want to talk about there?
All right. Getting money out. This is on inherited accounts. Now we didn't bring up inherited accounts, inherited IRAs or inherited Roth IRAs. We didn't bring them up on getting money in because you can't put new money in an inherited account. Okay. What's that's an account you get from someone who dies. Maybe your parents pass away and you inherit their account or a piece of it. you'll get what's called an inherited IRA, sometimes called a beneficiary IRA. Okay. Now there's kind of two categories of people with inherited IRAs. And we actually have a lot of them here, people that self-direct an inherited IRA. The first category is those that inherited the account before 2020. There's been tax rule changes on this. Before 2020, you got life expectancy. Let's say your parents passed away or your aunt or whoever you inherit the account from. And at that time, when they passed away, you were 40. Well, you get to take that account and take RMD on it over your lifetime. You can stretch it out over, the IRS thinks you're going to live another 40, 50 years. So you get to hold that and you get to keep that account for the next 40, 50 years.
That's if the person died before December 31st, 2020.
Correct.
Even if you didn't.
Before January 1st, 2020. So before December 31st, 2019.
Okay. And this estate could be still being settled and you may have not seen the money yet.
Right.
So you've got to look at the date of death of the person that had the IRA.
Yeah.
Okay.
Now, after this, there's just a 10-year rule. After this, it's let's say your, grandparent, parent, whoever passed away, and they give you you inherit their account. And this was in 2021 or 2020. Now there's a 10-year rule where you get the account and you get to stretch it out for another 10 years, but you don't have to take RMD at all. You just have to get it all out at the end of 10 years. So there's kind of two different crowds there. And there's a lot of confusion for people on which one they're in. And even the ones in 2019 or earlier, if the person wasn't in RMD yet, you don't have to take it yet. There's all these like complicated rules. So just make sure if you got an inherited account, which set of rules you're on, so you know how to take your RMD every year.
Okay. This is the reason some of you are like, where did Mark go? Is he multitasking? This inherited IRA stuff always, Matt and I take turns diving deep on topics because it's just so complicated sometimes. And Matt just knows these inherited rules better than I. So I want to ask this. So now everybody, here's a strategy I'm literally doing with my own mom. She's 82 years old. Just went down and celebrated her birthday the day after Thanksgiving. That's when her birthday is. And I'm opening a Roth for her. You can have a Roth at any age. She's on my board of directors. I talked about the business a little bit with her when I was there on Thanksgiving. And so I can pay her earned income to contribute to a Roth IRA because you have to have earned income. Social Security income does not count as earned income. So mom has to have a job. So mom gave me board of directors advice after Thanksgiving. So she's over age 50. So I can put $7,000 in for her and I can make me the beneficiary. Now I've told my brother and sister, hey, if I do this, that's my freaking money, so sign there, sign. Siblings love that. And so now I can invest my mom's crypto Roth IRA or real estate IRA or whatever I want. And when she dies, I get it. And even if I'm not 59 and a half, I can start taking money out of it and keep investing it for 10 years. Okay, here's my question. Do I have to divide whatever's in it by 10 and take a minimum distribution, or I just have to drain it within 10?
You just have to drain the whole thing within 10.
And that's traditional or Roth.
Correct. Yep.
If it was traditional, you'd kind of be smart to.
Yeah. You want to chunk it, this is reverse chunking.
Yeah.
Distribution chunking.
Okay. Cool. Now, this is where I think we go. Okay, cool. I'm good. I had another comment on getting stuff out. Can I go to that?
Yeah.
Okay.
I'm done. Yeah.
Okay. Because this kind of goes back to my earlier comment, but now everybody, maybe it's a little more salient, meaning it's appropriate at this time. It makes more sense right now. I'm trying to
word of the day.
Yeah, I'm trying to use some big words here and there. I get my Spanish word of the day on an app because I'm trying to learn Spanish, but salient, I just pulled that out of my
I liked it.
brain. Okay. So think about it. Let's say you have a Coverdale for your grandkids. Let's say you have an HSA. Say you have this Roth that you inherited, or you have this. If you're listening to this podcast, you're self-directing. You're like, I'm going to get the best damn return I can get. I'm going to combine with other accounts. I'm going to build LLCs. I'm going to do whatever investment. I'm going to buy gold. I'm going to buy whatever you want, right? We have to remember when you want to get that money out of that inherited IRA and you've invested it, you have to put the money back into the IRA to take the distribution. I cannot emphasize that enough. So important.
Mhm.
So it's a form, depending on the type of retirement account you have. We have chat on our website at directedira.com. And you can make a phone call and go, hey, I'm trying to get this money out. Please help me. Tell me how to do it. And if you say, well, I have real estate in my IRA, can I just take real estate? Can you deed me part of the real estate? Can you give me part of the LLC? Or do I have to sell this entire rental property in order to take the money? Matt, that was a tee up for you. What can I do? What are their options? Let's say my IRA owns real estate.
Yeah.
In an LLC, mind you.
Yeah. Yeah. Okay. Well, yes, you can deed. In this case, if your IRA owns an LLC and the LLC owns real estate, let's say you want to use the real estate, for example. Okay, we can take a distribution in kind of the LLC ownership, because when we'll transfer the LLC ownership from your IRA to you personally. And now at the end of the day, you own the LLC owns a property. Now you can go stay there and do whatever you want. But we have to get a value of that LLC. So we need a valuation. You got to get an appraisal of the property, you need the bank statement of the LLC bank account or any other assets the LLC owns. And then we can do what's called an in-kind distribution of the LLC asset. It's not easy, but it is possible. So it'll cost you $500 to $1,000 to get that valuation done.
All right. Now I had a client ask me this yesterday, and he said, well, in this example, they said, well, if I own Ethereum, a cryptocurrency, in an LLC, and I've got to take a distribution, can't I just give myself the Ethereum? And I go, you could, but the result is the same. It's so much easier because to sell the Ethereum in your retirement account, then put the money into sell the Ethereum in the LLC, put the money down into the retirement account and just take a distribution. You're going to be at the same spot. Because he was thinking, well, don't I get carryover basis? No, you don't. You're going to pay tax on the distribution, whether you sold it in the account before or you didn't.
Yeah.
So some of you may think, well, I want that Ethereum because my basis is so low. Well, you can't get out of the retirement account without paying the tax on the value if it's traditional. Now, if it's a Roth, you could do this in-kind thing, but why pay for the extra headache? Just sell it, go down into your personal account and rebuy Ethereum 9 minutes later. You're back where you started. It's just simpler and easier.
Yep. Yeah. Love it.
Okay. You're kind of impressed with some of my exit strategies.
Yeah. I'm like, man, you're getting some tough questions. Jeez.
Well, Matt, I learned from the best, Matt Sorensen.
It's true. Can't argue with that.
Man, is there anything else getting money in or getting out?
Well, okay, I'll give you one more that's coming up is the CARES Act distributions. People who took distributions under the CARES Act last year.
Give me an example.
Let's say you had a 401k or IRA and you're like, over COVID, if you remember in 2020, there was the ability to take up to 100,000 out of your IRA or 401k as a distribution, and you got 3 years to get it back in and not pay tax. All right. So if you took a CARES Act distribution in 2020, you would have had to put this on your 2020 return, at least pay 1/3 of the tax. Let's say you took out the max, took out the 100 grand. You would have had to put 33,000 as a distribution on your tax return and claim it as income. And the other 66,000 you'll do in year 2 and 3. But you still can put the money back in. So what's happening is we're seeing clients put the money back in now, but they already paid the tax on that first third. What do? Okay, well, we can book it back in, either that 1/3 or the whole 100,000, let's say. But let's say you just pay back in the 33,000. Well, you can go amend your return that you already filed and basically claim and go get a refund back. That's the process the IRS makes you do. So if you did one of those CARES Act distributions, just remember you got the full 3 years to get it back in, but you do got to pay the tax in 1/3 increments over that 3-year period. Now, but if you pay and still get the money in, the process to amend to get a refund.
Well, so as an accountant, let me ask this. On the 1099 or on the statement to show
the full amount, it's the 100,000. So you have to elect that it's a CARES Act and take 1/3.
Okay. Now I'm talking about putting the money back. So let's say you're putting the 33 back. You don't get to claim that on this year's return. You have to go amend on the year you took the income, and you're going to give a form that you would attach to the tax return to show that you actually put it back, and then the software would kick out what your refund is.
Correct. It's like that'd be a 2020. You'd have to amend your 2020 return. That's when you took the 100,000 distribution, but the IRS did let you only claim 1/3 of that when you go to calculate it for what the piece that 100,000 is taxable this year. So that's when you'll go back and amend. Say actually it's zero.
And I know this is frustrating for some of you that have enjoyed the experience of doing your taxes on Turbo.
You mean tolerated the experience of doing it?
Yeah. When you start taking money this way or another, or contributing to accounts and doing all this, you sometimes have to upgrade to a new accounting firm. And you know what? This is probably a good statement to make right now at this point, at the conclusion of the show. We've had calls at the office saying, hey, you guys are awesome. I really love your advice, but I can't, there's a wait list for your accounting firm. Now, remember, we're a three-headed dragon here, folks. When you hear there's a wait list, we're not saying there's a wait list for retirement accounts. There's not a wait list to talk to a lawyer and get your estate plan done, get your entity set up, get your CRT done. We're talking about a wait list to prepare your taxes, which is a lot more robust, or it's a bigger deal. A tax return takes a lot of time. And so we have a waiting list in the accounting firm. We are hiring and training as fast as we can. Please be patient. We don't need you to beat us up. We're not trying to create a bottleneck. Heck, I wish I had 100 new accountants tomorrow that I could train and have ready to go February 1st, but I don't. And so for you accountants out there that want to work with our firm, we are launching some new recruiting opportunities for clients, for accountants to work around the country for us and with us. But all of you out there, you probably do need to upgrade your accountant with some of these things you're learning. And so shop around, do the best you can, get on our wait list. We'd love to be of service in the years to come, and just be patient. Sorry, that was my plea.
Yeah.
Anything you want to add to that? No, I mean,
no. Yeah, no, we appreciate, I think, we're busy. I think one of the things I put out on my social media the other day was the great formation that we have instead of the great resignation, and all the new businesses starting up. We have so many new business clients, so many of our existing clients starting up new ventures or investments or partnerships and all this. And so it's a fun and exciting time. We love it. I said in my social, this is like the best stat of all of 2021 was all these new businesses, which is a symbol of people going out and taking control of their lives and their future and chasing their dream and getting more control, whether they're doing a freelancing or independent contracting or whatever it is you're starting out doing. But we're busy because of that. And so we're hiring even in the law firm, and we're doing a good job, I think, but we're trying to be a resource for you. And we want this to be educational. We want to cut the learning curve down so you don't have to spend money with us. Quite honestly, you don't need to be on paying by the hour or paying a flat fee or whatever for a lot of these services. That's the point of a lot of our educational content, why we're trying to do this, to just get it out there for free, give you that info, use us if we're the right fit. If not, that's cool. We still want to provide that same great free education for you.
A couple last announcements. The summit, we held our self-directed IRA summit a couple months ago. You can purchase the recordings for that now at sdirahandbook.com, probably the easiest place to go, Matt, right?
Yep.
SDIRA, as in self-directed IRA handbook, which is the best handbook in the country.com. Pick up a copy of the book, give it to a friend or family member for Christmas. Buy the summit for a friend or family member that loves to invest.
Yeah.
And that's a great gift if you're trying to find something for the person that has everything and they're into investments and finance, and you're like, what can I give them? Give them a free pass to the summit, and it could change their life. Kind of fun. My workshop videos for the last 2-day workshop was last week, the basic and advanced, and I did a 1-hour breakout session on cryptocurrency, which was exciting. We had Darren Charrington, one of our attorneys that's an engineer and just a geek on crypto. He talked a lot about so many unique things, but that'll be available by the end of the week, and you can get that at markjkohler.com. If you go to our main sites, there's links back and forth, but those are the easy places to go. Next week, we will be holding our annual year-end tax strategy podcast. Now that'll be at mainstreetbusiness.com. please get over there to the Main Street podcast and subscribe or follow, whatever. And you may just be hopped up on us just on directed IRA issues, but we got this whole other podcast with kick butt strategies. And so that'll be next week. And I'm going to announce it now, Matt, the January 29th. Can I?
If you want.
Okay, we're going to do it no matter what, right?
Okay.
Okay.
Yes. Yeah.
Okay. First, your guys are all here first. January 29th in Phoenix, Arizona, and it will be a live broadcast as well. And we're going to be doing some networking for those that want to make the trip or here local. We're going to hold the first ever cryptocurrency taxation summit, a full day of just beating the crap out of crypto and how to avoid taxes. And we've seen nothing like it. We're going to have a list of experts and sponsors involved. And so stay tuned for that. Any other announcements, Matt? You're in stuff?
No. I think we're good. Just remember, this is the end of the year. So you got your Roth conversion deadline. If you want that to be taxable for 2021, that's going to be December 31st. Make sure those doing solo Ks, like you're just like last minute here. If you're trying to do a solo K to do 2021 contributions, you got to have it set up before year end, even though you can contribute later into 2022 for 2021. Just keep in mind those deadlines. I'm sorry?
Is Christy really taking those?
So for about 3 more days. Yes. And that assumes you have all your crap together. So, and then, we're just here. Make sure you're signed up for the newsletter. You can sign up for it at directedira.com, markjkohler.com, sdrahandbook.com. Just get on our newsletter so you get updates on our podcast episodes, on some of these deadlines, some of our articles. I've got some great articles that I feel like I put out there recently. I'm a contributor on Cryptopedia now, Mark. So I know I think I told you that, but I got an article up there on buying crypto.
But are you on Wikipedia?
I am not. Do you have a Wikipedia page?
No, I don't. I've been trying to get one too. It's hard.
Yeah, I want one.
You know, it's funny. You get on Wikipedia and like, how does this nut have a page? But it's really a unique application process and how you get verified for Wikipedia. But anyway, well, everybody, thank you so much. And we'll see you next week at one of our 2 podcast locations. Hope all of you have a wonderful holiday season. See you soon.